put the spotlight now on the primary markets. And one of the companies which is heading for a debut there is Shelter India. And Rupinder Singh, MD and CEO of India Shelter Finance, actually is joining us now to talk more about the business. Mr. Singh, thank you very much for your time. Let's start by understanding about housing finance and for your company, the way it has shaped up since inception, because it is more tilted towards tier 2, tier 3 and beyond, where the growth is quite high.
Thank you so much for having me. Housing finance industry per se started late 90s somewhere in Indian market. Obviously, HDFC taking leaps and bounds that time, new entrants like Citi, ICICI coming into fray. After globalization, there's a boom into this market. So that is the time when housing industry was start mushrooming and taking a next level on that side. By the time 2010, housing per se become a very templated product as such, targeting primarily to the prime markets, top 15 cities of the country, mostly focusing on salaried as well as a creamy segment of strata while giving the loans around that side. India Shelter was founded that time in 2010, and the core objective was to be a little different. Those were the days when affordable housing was something which is not very understandable in the market at those days. That was a thought when this company was incepted, keeping in mind to target tier 2, tier 3 segments, particularly the self-employed, those set of customers who are considered to be out of banking ecosystem to large extent because their banking habits may not be as strong as you'll find into tier 1 markets or the primary segment particularly. So this is the time when India Shelter incepted their business, and focus was very clear, going deep into market in a geographies where these kind of customers are available. And yes, this is the real Bharat where the most of the customers are actually available. So we started with the very humble ticket size at that moment, targeting those customers which are not even filing ITR very regularly and have a very less meaningful banking habits, and serving the ecosystem in vicinity where they are operating. So 2010 we started with 2 branches. Eventually by the 2023 end, as we reaches, we are in 15 states across the country in 183 branches, starting from North Rajasthan to Tamil Nadu, one of the national company which is in affordable housing. This is the way the business has been acted around. Typically, our segment is a segment where the monthly income ranges anywhere from 25,000 to 60,000 rupees, and they look for a loan which is around 10 lakh rupees. Here, it's very pertinent to understand in this market, these are the customers who normally have their land already available and they want to construct. So a lot of our loans goes into the construction side, and also there are certain transaction loan in terms of sale purchase. So this is operators modus operandi for us. Today, we have a 65,000 customer across these 15 states, and average ticket size for us is around 10 lakh rupees.
That's the other thing that, what's surprising is that irrespective of the presence that you have in tier 2 cities and beyond, the low ticket home loans that you dispersed, you've actually managed to keep your asset quality extremely healthy. How do you manage to do that, and so much better than your peers?
So it is a matter of design from beginning. Actually, when we started this business, the clear thought was we have to target a segment which is beyond salaried, which most of the players likely to go with that, as it is easy to template and easy to work around. So from beginning, the underwriting models has been developed accordingly. The credit functions were given that kind of support from beginning, and the company has been created in such a way, even all hierarchies have been taken care. Business are separate hierarchy, underwriting mechanism is separate altogether, and definitely a collection to support that side. It has always been considered this market to be very risky, but our observation is if you do prudently, if you try to source these customers directly and engage them from day one, and education goes to the last extent in terms of giving them an idea that you will now offer bigger fray of the financial inclusion, your bureau also matter. So automatically customer is quite understanding. Our experience into this side has been a very good in last 12-13 years when typical on the credit side.
And now the RBI is cautious over banks' exposure to NBFCs. Given that 68% of your borrowings are from term loans of banks, will there be any impact on the cost of borrowings? Will there be a need for any, to look out for any other sources of funds?
As a housing finance company, we and also in the small ticket size, which varies from 5 to 25 lakhs. So banks' more inclination is toward the exposure which is on unsecured lending. Also, the loan against property product, what we are promoting from our company side, they also get covered into the PSL segment. So impact of these regulation is to make the systems more robust and encouraging the right set of business. And our most of the customer, in fact, all of the customer falls into that that category where I think we are very well conduced around that side, basically. So not a problem for companies like us.
Rupinder, I was just checking out the document which you have shared in the public domain. You have clocked closer to 40% growth last few years. I want to understand the potential of the target market you actually operate in across 15 states. Do you see a lot of unmet demand so as to at least the momentum for the sector will continue next few years as well? Not for your company, but for the space you're operating in.
Absolutely. If you see the certain data points also, which is available in public domain, there's a shortage of around 10 crores housing as of now in today's scenario in coming few years, basically. And the number of operators which are serving them. And out of these 10 crores, largely, most of them are in LIG and MIG segment, lower income group particularly, which will find deep into the markets. They're not a part of the large cities where we said we operate from. But deep into the markets. So 90-95% of business is expected there. And the reach to that extent is still, we have just scratched the surface. There's a lot to be done around that piece. Good housing company with a good focus approach, they are doing their bit. But I think there is a lot of scope and, a lot of trajectory going forward also. So I think demand is coming up in a big way. And this is the particular space which has been very well tested also. Not only demonetization time, but also in COVID and COVID too. Now that's give a lot of confidence and boost to this industry particularly. And I'm sure that in coming times, this will going to continue for a long time.
As to what your asset quality outlook be, can you give us some sort of a guidance? Because as of now, your NPAs are lower than most of your peers. Any guidance?
Being 13 years in the same segment, so we have honed the skills how to underwrite the things and having a control of that side. Except the COVID time of the 2 years when the NPAs has crossed around 2.3 or above, I think we are able to maintain somewhere between 1.1 to 1.3. This is the normal numbers that we continue to maintain. I think our track record itself shows that this is the way forward also, that we want to continue in that sense.
Out of the entire loan book, if you were to talk about beyond the home loan part, while there is a lot of opportunity there, good growth, but it is also seen as highly riskier. How are you managing growth while not, letting loose the asset quality on that part?
So important thing is first is our underwriting models where we have a direct interaction with customer from day one when we are meeting him. The education also gets flown into his while process of sourcing through that piece. Additionally, we also ensure that there's a loan to values, which is LTVs, what we call in our terminology, are being well met. So if we see the LTVs in this particularly segment are quite low compared to the other segments around that piece. So there's a skin in the game from the customer side also, and there's an exposure which has been given are being properly tracked around. Additionally, if you see there's a strong collection mechanism which we have created in last many years, so that customer is being regularly followed if there is some missing around on the EMIs. So this as a mix of all these three aspects: underwriting, direct sourcing, ensuring a controlled LTV, and a collection mechanism, that's helping us to run this engine, smoothly.
Okay, good to know that, and hope that only continues. Thanks so much for taking time out and joining in. That's the word from India Shelter Finance, talking about how their prudent risk management is going to help keep their NPAs under control.